the bond market was a vicious cycle. So there was a lot of entities that were holding those bonds on a type of leverage, and as they sold off, they would force other institutions to sell theirs, and that would get even worse and sell even like other institutions would have to sell theirs. So it's a cascading problem, and if you didn't have the central bank come in and buy some of them, you literally would risk having a failed sovereign bond auction.
Hey guys, welcome back to Everyday Finance. According to Lyn Alden, we are observing a shift from a period of consistent disinflation to a period of increasing inflation. Given the extensive period of globalization over the past 3 decades, China's decision to open up to the global market has played a significant role. As the Soviet Union collapsed and Russia opened up to the world, we effectively linked Western capital with Eastern labor. During this period, there was a significant decline in inflation and a scarcity of resources. Efficiencies and benefits are important considerations. There are certain drawbacks to that, and this has been an ongoing situation for quite some time now. The significant factors that led to industrial rates experiencing what some refer to as great moderation were essentially a structural decline in industrial rates. Experiencing a prolonged period of disinflation has posed a significant challenge. It's interesting how stability can sometimes lead to instability. When a system is highly stable and unified, certain factors can unexpectedly disrupt its balance. It is possible to establish the highest possible level of leverage on a type of account that is slowly losing value, but not at a rapid pace, and lots of things Lyn Alden discussed. So please watch the video to end and share this video, and subscribe our channel Everyday Finance. Thanks.
Yes, I think we're seeing a transition from a structurally disinflationary period to a more structurally inflationary period because we had the combination of globalization for the past 30 years. So as China opened up to the world, as Soviet Union fell and opened up to the world, we basically connected Western capital with Eastern labor and resources. And so this was this multi-decade period of disinflation and efficiencies, and kind of, all the benefits and some downsides that come with that. And so that's been going on for a while, and that's been one of the big variables that allowed interest rates to have their, what some term like a great moderation, basically a structurally declining interest rates and disinflation for a multi-decade period. And the problem is that the system, it's almost like stability leads to instability, because if you have a very stable system that has a unit of account that's gradually debasing, but not too quickly, that allows for the maximum amount of leverage to be built on top of it. Because if you have a currency that's very hard, borrowers are going to be careful to leverage it too much. On the other hand, if you have a currency that's rapidly devaluing, like the Argentina peso, lenders are going to be very reluctant to lend for long periods of time in that currency. And so it's actually that medium state of a gradually debasing unit that historically tends to gather the most leverage on it. And the problem is that eventually when you run out of the ability to keep lowering your interest rates and you start actually transitioning to to higher interest rates, that causes a massive shock to the system. And so, for example, the United States has never had 3 negative years in a row for Treasury performance, and we're on track for that happening now. We've had it happen before in real terms. We never have had it happen before in nominal terms, let alone real terms. And that's the collateral that underpins the system. And we even saw last year, UK's government got shaken up by the bond market, basically by the bond market's reaction to some of their budget proposals. And they actually had a personnel shakeup because of the bond market in large part, which is something we haven't seen in a very long time. And so I think what we are is we're increasing evidence that we're going through one of these sovereign debt crises. And that doesn't mean that it all happens next year, for example. Some of these things can take a pause for a period of time. If you get some degree of maybe de-escalation in the military conflicts, or you get a mild recession that helps kind of slow that down for a period of time. But the problem is that those issues are still there. And so when you get past that potential period of, say, brief stability, it's likely to happen again and worse is the problem. And so I think that basically until there's a big structural change or devaluation in some of these major currencies, this is kind of still going to keep bubbling to the surface until it kind of forces that outcome, which can be highly disruptive. And I think that's the path we're on.
According to Lyn Alden, the bond market's response to certain budget proposals led to significant personnel reshuffling within their organization. It's been quite a while since we've witnessed something like this. According to Lyn Alden, our current situation is characterized by significant growth. There are indications that we may be experiencing a sovereign debt crisis, but it's important to note that the full extent of the crisis is not yet clear. For instance, certain aspects can temporarily come to a halt during the year if you experience a certain level of uncertainty. If military conflicts are de-escalated, there is a possibility of a mild recession. Assisting in slowing down the process for a certain duration, however, the concern remains that those systems and issues persist there, and so once you surpass that potential period of temporary stability, it's highly probable for it to occur again and in a more severe manner. The problem is that Lyn believes that unless there is a significant structural change or devaluation in certain areas, these major currencies are widely traded and have a significant impact on the global economy. This will continue to resurface. Let's back to the Lyn Alden interview.
I think it's a low probability because we saw that whenever deflation tries to occur, the incentives don't allow it to. So, for example, back during the banking crisis earlier this year, when some of these banks failed, they could have said, okay, well, anyone with money that's over the FDIC limit, you're going to lose maybe 20% of it because that was kind of the loss on, say, Silicon Valley Bank. But instead, they said, no, everybody's going to be money good. And we saw the same thing back in the global financial crisis. They expanded the FDIC limits. They bailed out the banking system. And so I think that the people running the system have very little incentive to allow a deflationary deleveraging, especially because that eventually hits the sovereign bond market. Like, what is the main thing that they're not going to let default is their own sovereign bonds. And the problem is that if you start to get a deflationary deleveraging from this high level of debt, that fiscal deficit just completely blows out. And if the central bank is not buying that, then you literally just risk outright default. Like, for example, when UK had their problem last year, the bond market was a vicious cycle. So there was a lot of entities that were holding those bonds on a type of leverage, and as they sold off, they would force other institutions to sell theirs, and that would get even worse and sell even like other institutions would have to sell theirs. So it's a cascading problem. And if you didn't have the central bank come in and buy some of them, you literally would risk having a failed sovereign bond auction. And so whenever it gets to that point, even the people in the system that would prefer to be hawkish, they don't blink at protecting their own sovereign bond market. And so I think that basically you can only get realistically a deflationary deleveraging up until it becomes messy enough to threaten the sovereign bond market. If there's not enough demand in the system to buy those large amounts of bond issuance, that's when you get inflation. You get basically central banks doing what Japan is forced to do, which is where even if you're in above target inflation, you're still expanding your balance sheet for lack of better options. And so that's why I think that it most likely trends towards an inflationary deleveraging rather than a deflationary one. Now, we still have to watch for signs of a deflationary one. They could do, for example, things like bank bail-ins instead of bailouts that are more deflationary types of deleveragings. But again, once it's at the point where the sovereign itself does not have much wiggle room in terms of its debt and deficit management, that's when most of the deflationary options are basically off the table in terms of realpolitik, and most of the inflationary ones have a much higher probability of being turned to. That's my base case, yes, because generally when you have these periods of high inflation, the central bank just doesn't take that without a fight, right? So there's attempts, even in Weimar. We think of like the Weimar hyperinflation, but for example, if you bought gold on leverage, you got liquidated multiple times during that hyperinflation, because there were periods of time where the central bank would really fight back and harden the currency dramatically compared to gold. But then it's like holding a volleyball underwater. They can only do it for so long, and then they let go, and it's a whole nother wave of devaluation. And so what we're seeing now is that the major central banks, except for Japan, are doing their best to slow down money supply growth. In some places, it's even negative year over year. They're trying to slow down private sector bank lending. And it's been a kind of a mixed bag, because on one hand, they are slowing down the private sector. They are slowing down in inflationary pressures. But on the other hand, by increasing the interest expense for the government so significantly, especially in the United States, you encourage more, ironically, fiscal-driven inflation. So it's like they've reduced the bank lending-driven inflation. They've slowed down the economy so that we're not over-consuming oil and driving the price up. For example, there's various things that they can do to kind of slow down that demand side. But over time, as the sovereign bond market gets less and less stable, eventually they risk going to basically what Bank of England had to do, or what Bank of Japan's always doing, which is having to monetize the debt even when inflation is above target. And I think when they get to that point, we risk having a second wave of inflation. Now, as you pointed out, we already have some degree of acceleration. So there's other things that can cause that, like a firming up of the energy market and other things like that. So we're already kind of seeing stabilization in high levels of inflation, meaning that we're no longer getting kind of like month over month falling inflation. But I think in order to have a big spike, we would either need an energy crisis again, or we would have to see something like the Fed fail to maintain its balance sheet reduction in the face of high inflation, and then have to monetize that in a similar way that they did during the 2019 repo spike, in a similar way that they did during the whole kind of pandemic era.
Lyn Alden believes that those in charge of the system have minimal motivation to permit deflationary deleveraging, especially because that ultimately impacts the sovereign bond market, which is a crucial concern for them to avoid any default. Concerns arise with sovereign bonds due to the potential impact of deflationary deleveraging stemming from their elevated levels. When the debt and fiscal deficits skyrocket, it's cause for concern, especially if the bank is skeptical of that. And by taking such a risk, you are essentially exposing yourself to potential consequences. For instance, when the UK faced difficulties last year, the bond market became a relentless cycle. Many entries held bonds on leverage, and as they sold off, there were significant consequences. Compel other institutions to divest their holdings, exacerbating the situation and leading to further sell-offs by those institutions. Compelling individuals to sell their assets creates a domino effect, resulting in a widespread issue. However, the intervention of the central bank, which purchases a portion of these assets, can help alleviate the situation. If you reach that stage, you run the risk of a failed sovereign bond auction. So it's crucial to be mindful of this possibility. Even those who would typically lean towards a more cautious approach to the financial system show no hesitation when it comes to safeguarding their own interests. It seems that the sovereign bond market suggests that the most realistic outcome is a deflationary trend. When deleveraging reaches a point where it poses a threat to the sovereign bond market due to insufficient demand for large amounts of bond issuance, things can get messy. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.